All right, guys, welcome to this session. All right, the Smart Money Show. Some of you have attended it in the past, and a lot of you have been uh, angry with me that I have stopped doing that. So when Vinod contacted me, said that let us do some sessions for these guys. I said, okay, let me take this opportunity and bring back the Smart Money Show. At the end of the day, both Bell TPO and I want to just share whatever we learn, through our experience with you guys. So under what banner it happens, I don't care much, but Smart Money Show, there were people who were really, liking that. So I said, let us bring it back. Okay. So here we are. Now I have a, not exactly a presentation, but I have this. This is what I was thinking. All right. I use mind maps extensively to just bring all my thoughts, organize them properly, so that whenever I'm sharing something, it happens in a nice organized manner, right? So I will be referring to this uh, every now and then, and if you want, I can share this image with you also, right? So this is the process. Basically might look very complex, or you might think that okay, there are so many steps, Dean, how can we actually implement these in real time? Because today's session is about finding short term trades, all right, using market profile and VSA. Now most of the things that you see in this particular mind map, they will become second nature for you. Okay, once you start implementing them, it won't take you more than a minute or two to understand what the market is trying to do at this particular moment. And if you have this organization, it will become much easier for you to kind of not forget something. If sometimes what happens is the market becomes volatile, it gets too exciting, and what we do is we forget an important step. So you can put this on your desktop screen or print it out, and paste it on the wall in front of you, so that whenever you are trading, you can remember that okay, this is the sequence that we have to follow, and once we follow this sequence, the chances of approaching the market correctly increases dramatically. Now I have always said that once you start understanding the market better, your trading also improves, all right? So many people, they just straight away jump into finding the trades or finding the trade setups, or copying from some trader. Nowadays if you go on the YouTube or Google and you search options trading, you will get ready-made strategies. Nothing wrong with that, but the issue is if it is not implemented correctly, it will, and if you miss some important steps in the meanwhile, it will completely take you in the wrong direction, and then you won't realize what exactly is going wrong here. Okay. All right. So this is my process of finding short-term trades using market profile and VSA. So let us start from step one, that is at the top, and then move down to the last step, and then we will go on to the charts and try and find some examples for the same. Okay. I hope you can see this. Let me see if I can make it a little bigger. Oh, okay. So let us start with the first step. And the first thing that you need to do is select an approach, right? Now, I'm not saying this is the only approach you should take. I prefer to use the top-down approach. It is the logic behind it is simple. Okay, top-down approach means you start with the highest of the time frames, and then you move down to the shortest of the time frames. And you can see this can be, someone like investor like Warren Buffett, to a scalper, or someone doing high frequency trading, that kind of thing. So this varies a lot. Okay. And when I say time frame, I am not talking about monthly chart, weekly chart, daily chart. No, this is not what I'm talking about. What I'm talking about is, this is like a very important concept if you want to trade using my framework, which I call the complete trading framework, is you need to understand the difference between chart periodicity and the time frame. So monthly, weekly, daily, 30-minute, 5-minute, 1 minute, these are chart periodicities which you can change on your technical analysis software whenever you want. The time frame is something that should not change frequently, right? And if you are starting, it should not change at all. Okay, so time frame is how long you're going to hold your trade. Okay, so someone like Warren Buffett, he just takes one side of the trade, rarely thinks about selling. Now that is what you can say, it is a myth about Warren Buffett. It's not like that. He's a fantastic trader, but yes, obviously he's not trading very short term and not using charts and all. He's using fundamental and economic principles, and he also takes some short term bets. So but if you are trading from his time frame, you are planning to hold on to a company for a long time, you become an investor, and then you start moving down, right? Then there might be traders who want to hold for, let's say, a few weeks to a few months, because there is a trend in the market, they want to capitalize on that. They become long swing trader. Someone who might be holding trade for less than a week or two, he becomes a short swing trader. Someone who just wants to take a trade intraday, does not want to carry it overnight, becomes an intraday trader. And also there are people who are holding trades for even minutes sometimes, or even seconds. These become the scalpers, all right? And then there is some computerized high frequency trading, which we should not get into, because it takes a lot of money and technology and everything to achieve that. I have never delved into that. Anyways, now that we know that we have to start at a higher time frame, what you need to understand is that uh, the higher time frame trading is going to impact the markets more, right? So higher time frame trading is going to impact the markets more than shorter time frame trading, but it is not always true. Sometimes when the higher time frames are not interested in trading, the shorter time frames will step in and they will control the market. So what you need to understand is which time frame is in the control of the markets at any given point in time. So if you miscalculate that, all right, now when we go to the charts, I'll show you. Let's say the market is trading in a narrow range, and suddenly it starts trading around the top of the range, and you have the habit of selling the top, all right? Why? Because it has been working for such a long time. So you sell here also. But instead of going down, market blasts to the upside. What has happened here? What has happened is the time frame that was in control of this market, selling at the top, buying at the bottom, that was its bread and butter strategy. Now they are losing control, and now the control is in higher time frames hands. So this range was broken, and now you get a very big breakout, and you keep wondering what happened. Okay, why the market has stopped working? Then some people will come and tell you that, okay, this was a consolidation, this is a trend, and you should always trade with the trend. But then for all these days or months or weeks or hours, market simply was not trending. So how do you know that when a new trend is beginning? A new trend will begin when a higher time frame steps in, takes control of the market, all right? And that higher time frame for me personally is the person who is going to hold his trades for weeks, a few weeks to months. In other words, long swing time frame. All right. What do I do personally? I trade on market profile using this 30-minute chart periodicity. But my trades are not more than 1 to 2 weeks. Okay. So mostly 1 week. I'm trading for the next weekly expiry. So if I'm holding for less than a week, my time frame is short swing, sorry, short swing, yeah, time frame. All right. And then there is one lower time frame. All right. These in my case, like who's the shorter time frame than short swing time frame, they are intraday traders who won't go beyond 1 day. They want to take a position today and they want to square it off today itself, right? So now you need to understand, like when I start doing my top down approach, and we will do it on the chart, so don't worry. I start on the daily chart, I see what the long swing time frame is trying to do, and then I go to 30-minute chart and see what short swing time frame is trying to do, and then I go to 5-minute chart properly, and then try to find out what the intraday time frame is trying to do. All right, what will this all information give me? It will tell me what I should do in my time frame. Please understand, it is very important to keep a tab on higher time frame and lower time frame, because then you will understand what you should do in your time frame, and the chances of success of these trades are much higher, because one, you are not going to go against the higher time frame, and you will be aware what the shorter time frame are trying to do. Okay, sometimes you may have faced this issue, is that you take a trade, right? There is a, let's say you want to buy this pullback, so you buy this pullback and market goes higher, comes and stalls at this previous swing high. Now you bought here, maybe your stop loss was somewhere here, but as the market has moved in your favor, your stop loss comes here. That is the rules of your trade management. And then market quickly falls, takes out your stop loss, and as you are wondering what happened, or should you reverse, or god forbid you have not reversed yet, but if you have, then you're in more trouble, because then market just simply blasts off to the upside. So what happened here? All right, what happened here is you were trapped by shorter time frame. All right, and that is the reason why you have to keep tab on this. Now what exactly happened here, I am going to explain that also, so I'll just try and keep this on the chart here and let us move on. Okay, so what I said, you have to look at one higher time frame, you have to look at your time frame, and you have to look at one shorter time frame, and that is how you move in your analysis. You start with the higher time frame and you go towards the lower time frame. Okay, so that is the top down approach. The next important part is to find out what is happening in the recent past. All right, I'm not talking about going back 6 months if you are a short swing trader. Why? Because what happened 6 months ago is does not have too much of impact on your time frame or whatever trade you are planning to do. It will have, but it will not be having impact continuously. At some point in time, when there is going to be a big breakout or we are approaching a big support, yes, the higher time frame will impact, and in that case maybe something 6 months old will also impact. But usually on regular days, this very high time frame or very references which are long in the past, they are not going to affect your analysis much. So what you have to look at is recent market development. This is very important, right? So what do you look at? You look at ranges. What are the ranges that are forming on the charts? Then you try to mark some of the references. Obviously bell TPOs, advanced softwares have so much of features, they will plot all this automatically for you, right? So HVNs and swing highs and lows, uh, you know uh, poor highs, weak highs, all those references are automatically marked. uh, so you mark these references, you find out some important HVNs above and below the market, you find out where are the swing lows and swing highs. So now you are kind of creating a framework around the recent market development, where you will decide to take some risk in the market. You will decide to buy, you decide to sell, whatever it is, but you need a framework. All right, you need some references, some logic for those references, and then and only then you will be able to take some trading decisions. And what that framework, making a framework around current market development is called as context. Context is what has happened in the recent past and how it can affect the current market development. Then we come to time frame analysis. What we did here, higher time frame, lower time frame, and let's say your time frame. This is nothing but time frame analysis, right? So I wanted to show you the sequence in which I move. Starts on daily, then 30-minute, then 5-minute. But now let us look at the time frames in a little bit more detail. So what I believe is that if you want to be consistent in the markets, all right. See, figuring out the markets in itself is a difficult task. And now I don't have to tell you this. Everyone who has been a trader for even one day knows that it's difficult to figure out the markets. Good. Add to that, every trader, almost every trader, will have a different idea, different trading idea, different expectations from the markets. So what happens is, when all these people they come together with different expectations and different ideas and different maybe skill levels, different amounts of capital, different amounts of time available to trade, all these things, when they come together, a big mess happens, which we call the markets. So how can you make sense of the actions or intentions of different traders? Is you divide them into different time frames based on how long they are planning to hold the trade. Now, I don't care whether you are in a job and you only get 15 minutes to monitor the markets in the morning, and maybe 15 minutes during the lunch break, and then you can't look at the markets. Okay. But if you are in those 15 minutes and you are taking a trade, what I am more interested in is how long you're going to hold it. So maybe you come at 9:15 because you have time from 9:15 to 9:45, let's say half an hour, and you take a trade here, and then you have let's say lunch break from 1 to 1:30. So you're going to close your trade here, or you already have taken a trade, you have put in your stop loss and target levels, and you come back and you look around 1:30. What has happened? If your target is gone, stop loss is cancelled, you have made some money. If your stop loss is hit, your target is not reached, or if the market is somewhere in between and you take a decision here and you square off your trade. So what is more interesting for me is that you are only going to take a trade for the day and you're not going to carry it overnight. So for me, you become an intraday trader, all right? And if I am trading short swing time frame, you become one lower time frame for me, all right? Now, uh, that is one kind of a trader. Now, I have a position, let's say, a short-term position. I want to, maybe I have established a credit spread for the upcoming expiry, and suddenly, market starts going against me. So what I have to look at is what is that invalidation level where my trade idea is proven wrong. All right. And if the market is going against me strongly, it means that the higher time frame have taken control. Right. And if the higher time frame is deciding to go against me, or I mean whatever they are deciding, but if I have decided to short and they have decided to buy, obviously we are in conflict. In that case, I should curtail my trade short. I should not fight with the higher time frame. I should fall in line with the higher time frame and try and do everything to manage my trade such that I don't make a big loss, or at least I get out at some minor profit, right? Okay, so the higher time frame I call as discovery time frame. The time frame that you are trading in is what I called the status quo time frame. And the time frame that is going to be lower than you, like the intraday traders, that is the exhaustion time frame. Right now we will look at charts and I will explain exactly why I have named them like this. Now if you have been part of a complete trading framework, or if you have been trading with me live in the co-trading workshop, you know why I use these terminologies. But if you're new here, I will definitely answer your doubts regarding this. Then we go to the third step, that is confirmation. Okay, you have an idea in your mind, like I want to trade like this, I want to do that, or maybe you have an idea about what the timeframes are doing, what are the important references, and all those kinds of things. And then market opens and it starts to do something. Then what you have to basically look at once the market opens is it confirming what you thought about the markets or not? All right. So you believe that, okay, there is this range, and I believe the market is going to break out from the range. All right. Now, once the market opens, okay, so you basically do not have all this data. Now, how much data you have is this far, okay, and now where the market goes is more important. You believe that, okay, there was a trend earlier and this is just a pause and market is going to go higher. Now you have to look at the confirmation for your context or whatever you are believing about the markets and whether it will do it or not. And how do you do that? By tracking the current market development. That is what the market is doing right now. Okay. Okay. So the first step, you look at open and opening. Now, please don't ask me ORR, all right, or open drive. Uh, do you have a strategy based on that? What does open drive mean? What does open rejection reverse mean? I don't know. I don't care. I have stopped using that. Okay, these don't work. Don't go for that. Okay, but what I will do is I will look at the open and the initial activity, that is the opening, in relation to what I was thinking about the markets. So I was thinking a breakout and market opens. Let's say this is the boundary for, this is yesterday, okay, and this is day before yesterday. All right, so we have first day and second day, and now you're looking for trade on this day and you're looking for a breakout. And what happens? Market opens here, that is below the range of previous day. Okay, now you just by looking at the open, don't you think that if you're looking for a long trade on this day, maybe you have established a position anywhere on this day, right at the low or right at the highs or anywhere in between. When the market opens here, what do you think all the buyers from this day are feeling? They are feeling pain. They are feeling the pain of loss. They are feeling the pain that their analysis is wrong, right? So right at the open, they are not feeling too good about it. Now you wanted the market to go higher, market opens lower, it has immediately given you some confirmation that you may not be entirely correct. Okay, at least for the time being. So you look at yesterday's range, you look at yesterday's profile shape. Why profile shape matters? Now, obviously, you are here, you're interested in market profile. Although I'm going to talk about VSA more, but yes, I'll also refer to market profile because I cannot trade without looking at market profile chart. Okay, so yesterday's profile shape and open and opening in relation to yesterday's range and yesterday's profile shape, all these things matter. And I just gave you an example how an open might immediately tell you that you are wrong. Now, after opening here, if it goes lower immediately, these people are screwed. So they will run for cover. They will try to sell their positions and the market will accelerate to the downside. If it goes higher, still they will come in and sell because the opening already have given them a minor heart attack. Now the market is going higher. They're looking for a exit. All right. So sometimes market opens lower, comes back, but does not go to the previous day's high. Somewhere in middle, it starts to go back down. Why? Because all these trap traders are trying to exit now and they will sell at every opportunity. And that creates supply and market goes down. So yesterday's range, yesterday's profile shape, where are we opening in relation to that will give you the initial idea. Then once the market has opened, then you have to look at the trade facilitation. Now, this is the word that is used a lot when you're talking about market profile. What does that mean? It simply means is that okay, the market okay, this was the range of the previous day and this was the day before that. You believe the market should go higher, but market has opened lower. What is it doing after that? Okay, so as I said, if it immediately starts going down, now we are talking about market profile chart 30 minutes. So first 30 minutes it goes down. Second 30 minute it extends the range to the downside. Okay, so basically this is A period, this is B period. So B period has extended the range to the downside. That is what I call IBREX or initial balance range extension. This is a very, very important sign. All right, that market wants to go lower. Why? First, yesterday's low is taken out. Second, A period low is taken out. So not only have we opened weak, we have shown further weakness. Now, once this happens, unless and until the A period high is taken out, this market becomes short on rally. All right. And then what you need to track, you need to track subsequent range extension. So what happens in C period, D period, E period, F period? Are we extending the range subsequently in C, D, E, F? Maybe G, H moves sideways, I again extends the range. Is this range extension continuing or Not. Makes sense? So when the market has just opened, the IB range extension is essential, and then C and D period or maybe E period, what they are doing. This initial 2.5 hours of the market comes under, the morning development. So we'll look at that. And what we will look at is, where is it happening, right? Where exactly is it happening? So I'll draw this again. So this is that day, trend day. This is that sideways day. And now you have, sorry for that. Let me draw it a little better. Yeah. And you have opened here. Okay. And you have gone lower in A period, and now B period also has extended the range, and C also has extended the range. Okay. Now what you have to look at is, what references are we at? Okay. So let's say before this day market was going low. So this is a swing low, this is kind of a swing high after the lower open. Now we have a small range. This is the top, this is the bottom. All right. And we may be having a bigger range, and that is the bigger range top. All right. Now when yesterday opened, it went to that previous top, previous range high, and then it struggled, and now we have opened lower. What does that mean? That this range is going to be maintained. Selling is coming in at the top of this range. This is kind of a new range, 2-day range, and if we go back there again, selling should come in. All right. Now we go lower. What we have this bottom. This also might be, or maybe the previous bottom is here. So right now this becomes bottom of the 2-day range, but also the swing low. Now let's say market falls sharply in C period. All right. So we have A, B, and C, and it halts here. Now D period is an inside bar, E period is an inside bar, and F is trying to go higher. What is happening here is, despite weak opening and some initial strength, this swing low has halted the market. Some buying is coming in, some profit booking is coming in, and that is pushing the auction higher. Make sense? So that is the importance of references. Many people, what they do is they look at references and they say, okay, if market comes here, I will buy. All right. Or if market comes here, I will sell. That is not the way to use the references. References are, in short, let's say, decision points in the market. All right. So what do I mean by decision points? Is like when the market comes there, a group of traders have to make a decision whether they want to continue with the trade, whether they want to enter a trade, exit a trade, what to do. All right. So whenever there is a decision point, traders will become active, and as soon as they become active, market has the higher likelihood of moving in either direction. Okay. So it can continue the breakdown, or it can reverse and give us some sort of inventory adjustment. All right. So that is why these references are important. So whenever I am talking about references, I am not talking about action points. All right. So these are not action points. No, the references are decision points, not for you. And obviously, like if you have still holding the long, and if it starts to break below this, obviously you have to get out of your trade. So you had to make a decision. But if you are not in a trade, okay, then instead of coming, when the market comes here, instead of making a decision instantly, you observe how other traders are reacting to a reference. So while it becomes decision point for many traders, for us it is an observation point. What are we observing? We are trying to observe what the market does at these references, what other traders are doing at these references, and that will give us further confirmation of whatever context we thought was developing. All right. So we will look at these three things. Then comes the time to develop a trade idea. Okay. Now many people think that if I have understood the context, I can straight away trade. No, context needs confirmation. Okay. Once you have confirmed that your context is playing out, then you have to develop a trade idea. All right. You have to develop a trade idea. Why developing a trade idea is essential? Very, very simply, unless and until you have a clear idea about what you are going to do in the markets, how will you know when you are wrong? Okay, let me give you an example. Okay, so on the higher time frame, you believe, okay, that there was a longer term resistance, and as I said, market trended higher, traded sideways, opened lower, and you have this. Okay, now the question is, when you, I mean, this is the day you want to trade on, this is previous day. Okay, when you are analyzing this previous day, you and you have confirmation. All right, so you look at this day, you look at this resistance, and what you see, okay, a lot of traders have taken the decision to book profits. Some of them may have sold looking at the resistance. In short, supply is coming in here. Make sense? So this was a decision point. Decision has been taken. Lot of selling has happened. Next day opens lower. It gives you confirmation. Okay, initial confirmation. IB range extension, subsequent range extension, more confirmation. All right. Now you have to develop a trade idea. What is your trade idea? This is the swing low, right? So the C period has not fallen yet. But as soon as this happens, you have two ways you can trade. Either you can sell below the B period low, like below this. As soon as it goes below this, you sell, or you wait for a pullback and then sell. Make sense? So till what point you should let the market pull back? I use VWAP for that. All right. So all this will become clear on the charts, but I'm just giving you an example. So as soon as the market goes to VWAP, you should sell. That is your plan. It might or might not give you an opportunity to do that. So if you decide to sell the breakdown below the B period low, it can come down a little and then pull back. And in that case, you will be in a lot of pain. And if you are waiting for a pullback and market straight away falls, that will make you lose this opportunity. So there is always a trade-off. So you may ask, Dean, is there a way where we can make sure that we never lose a trade or never go wrong? No, you will go wrong. You will miss the trades. That is the truth of life. Now, this trade you have missed. Okay, this was a trade idea you had. Now you have missed. What should you do now? You're looking at a trade idea. It did not. You wanted a pullback, and it has straight away gone down. Now you come to the next reference. Okay, so far you are tracking this yesterday's low. Opening below yesterday's low told you that okay, there is a confirmation of sellers. IBRX subsequent range extension gave you further confirmation. Now you're waiting for a pullback. Did not happen. Straight away market fell. Now instead of saying that yes, I am very confident that the sellers are in total control, no, it has reached another reference. So this was the decision point. This again is a decision point. And instead of jumping into a trade here or on any pullback, you should now look at what decision traders take at this reference. So your decision or your trade is again postponed, into the future. Why? Because of this. We have come to another decision point. Right? So if you are long and this is your stop loss level, obviously you have to exit. And that is what I am monitoring. Okay. Let's say market continues to fall. What it tells me is selling is strong. But let's say it goes below this and recovers immediately. Then that tells me it was just a stop hunt. So whoever had placed their stop losses here, their stop loss were taken out, and now the market may go back up. Now my decision making changes. Okay. Now my trade idea changes. Here my trade idea was to short. But when this is happening, I may not want to short. I may want to buy. Make sense? Because we are trying to trade short term. We are not here to buy, ITC as an investment. No, we are here to trade short term. So you have to develop a trade idea. Okay, once you have some confirmation, you develop a trade idea, and then you look at references which you are going to execute your trade at. Okay, so we looked at references here. We will look at them again. But these references will be action references. These references where the references where you want to see what decision traders are taking. But now you are looking at action references, all right? And they are mentioned here, and we'll go to that in a minute. All right. What again you have to do is Once you develop a trade idea, and obviously, like as I have always said, that the time frame should be pre-decided. Okay, so when you come to the markets and you decide, I want to be an intraday trader, or I want to be a short swing trader, this is the first decision you have to take. What you want to do. If you want to do intraday trader, you have to do things completely differently. If you want to be a short swing trader, you have to do things completely differently. Process is same. References will change. Your time frame, higher time frame, lower time frame will change. All right. Important reference zones will change. Action points will change. So that is the reason why you need to first be very sure of the time frame. So even though I have written it here, select a time frame to trade, you have to be sure about that beforehand. Okay. Now that you're developing a trade idea, so in this case you're trying to short, and that was an intraday short. All right. Okay. Then you monitor one higher time frame, one lower time frame. So again, let come here. So it's the down move, up move, consolidation. Okay, this is the uh, top of a bigger range. Market opens higher, does this. All right. Now we have a swing low here. Okay, and you are an intraday trader. And what I said, you were waiting for a pullback, but it straight away failed to this. Now you have to monitor one higher time frame. Now you know that there is a rough 2-day range. You are an intraday trader. As soon as you reach here, the status quo time frame who wants to maintain this 2-day range is going to respond. So even though there is weakness intraday, the higher time frame is coming to is coming from the buy side. Why? Because it is expected behavior. This is the swing low. These guys are supposed to come here and defend. So your time frame is lower time frame, you want to short, but no, higher time frame in this case has come in and they will support, because this is a swing low. There is a very high chance they will support. If they don't, then obviously you will get much more downside, but still, that is later in the day. Right now, the expected behavior is they will support. So you have a short position. Let's say you got the pullback, or you sold below the B period low breakdown, and market has given you nice move, and it comes to swing low, and there is a chance that higher time frame might respond. What you do? You get out. Why? Because your time frame was intraday. Higher time frame is likely to buy here. Why would you continue to hold on to your position? Okay. Now you might say, okay, Dean, if we book our position here and then it again falls, then what? That is why part booking was invented. All right. This was the response of smart traders to this problem. Start with, let's say, even 2 lots. Book one here, hold the rest of the position with a stop loss at cost plus brokerage even. All right. So that is the simplest way to solve this problem. All right. So you do that. Okay. You monitor one higher time frame and you also monitor one lower time frame. Okay. And I'll show you examples of lower time frame on the actual charts. So you monitor these. Okay. Once you have a trade idea, once you have selected a time frame, you monitor one higher, one lower time frame. You look at action references. So what are those action references that you will be looking at? Because that is where you're going to execute your trade. First, VWAP. VSA signals are important. Some basic price action patterns can be useful to enter or exit a trade. Many people ask me, how do we enter a trade? Okay. Do we enter a trade on VSA signal? Now, I sometimes say very, very mean things about price action because I don't believe in price being the supreme thing. I believe volume is the supreme thing, and not the vertical volume. Volume as in price into time. All right. That is the definition of volume that market profile uses. Okay. Anyways, so you can use any of these, right? Market opens weak. This is the VWAP. Pullback happens to VWAP, and you sell. This is a very good sell. Simple. Where is your stop loss? If it accepts above VWAP, that is your stop loss. Simple. Get out of your trade. Make sense? So you have to look at some of these references. If let's say market comes lower, and uh, no, there is a VWAP, the market goes back up, and as the market is kind of consolidating just below VWAP, you see a lot of no demand towards the highs and no supply. I'll show you examples on the charts. This tells me that shorter time frame traders are active. Immediately selling this would be a bad idea because the higher time frame might want to test first and then sell. So you wait patiently, and when this test happens, then you sell. Make sense? So that is why VSA signals can be invaluable. Then you look at some simple price action patterns. Okay, you will say, why should I complicate? I see a flag developing. If it breaks the flag, I'll sell. Fine, that also works. All right, as long as your context, confirmation, trade idea, everything is on point, even simple price action patterns work flawlessly. Right now, once you are in a trade, you have to monitor it. Just a while ago I showed you example. Your market is going lower, but there is an important reference. You are short somewhere here, and you have to book some profits here because there is a possibility that some buying may come in, especially if you are an option buyer. Then it is almost mandatory for you to book some position here, right? So you monitor ongoing trade facilitation. What is that? One time framing, range extension. What do I mean by that? Simple. So this was your A period, B period extended range, C period fell sharply. And then if you get this, next 3-4 periods are just moving sideways. This is poor trade facilitation. Market is not doing a good job of going down. Someone is booking profits aggressively, or someone may be coming in and buying because this is an important reference. Makes sense? So range extensions have stopped. One time framing is just lower highs or higher lows. So if the market is going down, lower highs are forming, that is one time framing. If the market is going up and higher lows are forming, that is one time framing. Range extension, you go beyond the range of previous 30-minute time period. So here we are not going beyond previous 30-minute time period. That is a warning sign. All right. And then you can still hold on to your position, maybe tighten the stop loss or whatever, because there is likelihood that we might break down or we might go back up. If this happens, your stop loss takes you out of the trade. If this happens, your stop loss has kept you in the trade, making you more money. All right. So you monitor ongoing trade facilitation. Then you look at risk management. Now this obviously, again, like selecting your time frame to trade, should be done beforehand. You should already know how many shares you are going to buy, how many lots you are going to buy. All right. uh, don't jump into the markets without knowing this. How much should you trade? Obviously, I mean, I have conducted a whole intensive on the topic. There are so many great inputs, in the complete trading framework regarding that. So you can refer to that. And there are obviously YouTube videos also regarding some risk management principles. You can refer to that. So you have to decide first, beforehand, how many shares are you going to trade, how many, lots you are going to trade. Uh, and this is very important. All right. Okay. Then you come to your stop loss, right? Stop loss is essential. Stop loss is mandatory, but not the way in which you are taught so far. So many a times, stop loss is the last thing that happens in your trade. Okay. So what do I mean by that? Let's say the market is going higher. Again, the same example. Okay. You buy on this pullback, you put your initial stop here, market goes to this previous high, you move your stop to. So that was the stop loss initially. Now your stop loss is here. Now the market comes down and your stop loss is hit and you got out of the trade. This is the last point of your trade. Okay, so your trade was initiated here and your trade ended here. For me, stop loss is something that should avoid catastrophic losses. What do you mean by that? Difficult word. Most of you know what it means. It means like a very big loss, or a loss that will completely destroy your account. Okay, which usually happens with uh, short option trades on expiry day. If market rallies sharply, these guys are killed. All right. So we don't want catastrophic losses to affect our account, but smaller losses are allowed. Getting a couple of trades wrong is allowed. So stop loss is not there to help you get out of a trade. It is there to protect your account. There is a difference, right? So when this was happening, there is a pullback, right? Market goes here and it is now exhausting and market has come back down. This is expected behavior. Okay, this exhaustion at previous swing high is expected. How severe is it going to be? You have to have a reference that will tell you that okay, this is serious. So it might be somewhere here. Okay, this is, let's say, let's take that swing low itself, right? So this is your swing low and this is your stop loss. If market goes below that, the whole premise of trading is negated. Now, does that mean you should not get out of your trade till it comes here? No. You see exhaustion here, you let the market come down, you know that there are stop losses of shorter term traders here and market will run those stops. So you should not place your stop here, let the market run it and then see whether it goes back up or continues to accept here. Because if it continues to accept here, you are not going to wait for this, you will get out immediately. Make sense? But if it goes back up, you are saved in this position. Now you do not have to scratch this trade because the market is going back up. Maybe this time it will break out and you will get a good trade. Make sense? As soon as it kind of fails to go below this low, some aggressive traders might come in and add to their position. And then you see this happening. Market is not actually going back up, sustaining below this swing low. Yes, the next stop is this. So you should immediately get out of your position here. But if you get out in anticipation, you put a stop loss here, market hits this level, you're out of the trade, and immediately market starts reverses and goes back up, you will feel very, very bad. But let's say you took this position, you have a stop loss here, and then some urgent work comes in, or if you're in a job and your boss calls you for a meeting, or maybe whatever, you're dropping your kid to school with this open position and stop loss in place, and for some reason market falls sharply, you're out of your trade here. So you will make a loss, obviously much more bigger loss than getting out at this point, but it will not destroy your account. And if this market reverses back up and you come back after doing your work and you find market trading somewhere here, then you will thank yourself that your stop loss was here. Okay, so stop losses should be at a level where the trade idea is invalidated. Okay, that particular position that you have taken, you should not get out of that so soon, because many a times that is the reason why traders don't make money, is they get out of the trade because got out of their position. The trade idea is still valid, but now they are not in a position. Okay, and then that creates a lot of frustration. So don't do that, don't do that. Okay, uh, again, I mean, I am trying to give you as complete a picture as possible. Not always possible to do it in a short span. Okay, so we have already ran through almost an hour. Okay, now let us go to charts and let us take example of bank nifty, and let us go through the top down process. So what you do first, you look at the daily chart. All right, we are trying to trade this day. So uh, just imagine that this is not there. Okay, if it was a live market day, it would have been great. But anyways, so okay, what do we have? We have some important references. First is this swing low. We have already tagged it here. Now we are coming back here. Okay, there was a pullback and we have come back to that reference. We have a swing high here, so we are in a bigger range. We have another big range below the markets. All right, and this was the breakout, test of the breakout and continuation. Now we are back to that test level. All right, so now you need to ask yourself one question. Look at previous swing lows, this one, this one, this one, this one, this one, this one, and this one. All right, now what is happening here? Most of the swing lows were never visited. Okay, 1 2 3 4, this was visited, not good. This again is getting visited, not good. What it tells me is that buyers are not strong now, as strong as they were earlier. They are letting the market fall a little bit too much. twice it has happened, there is a likelihood we will come and test this. Why? Because now the buyers are not strong enough. Like, you see this move and then it defends. But why is it letting the market come back to this swing low? Right here itself, why it did not push it back up? These are the questions you need to ask. So on the daily chart, I see that there is some weakness. All right. This exact day might not give you that weakness, but overall the mood is weak. All right. That is the analysis that I have done on the higher time frame. Then I go to the profile chart. Okay. And on the profile chart, I will have to look at what is happening over the last few days. All right. So we are trying to trade this day, and let us look at what has happened before that. Immediately I can see that yes, there is a range. There is a range. All right. So as we go towards the top of the range, supply comes in. All right. And as you come to the bottom of the range, you are seeing some demand coming in. But over the last few days, we are making approach towards the bottom of the range. Right. Now if we come to the bottom of the range, what is the expected behavior? Buyers should come in and push the auction back up. If it does not happen, buyers cannot push the auction back up. What it tells us is that buyers are not trying to defend this low, the low of the range, and in that case we might explore lower. Make sense? So this is how you are going to track the markets. All right. Let me show you a previous example where it broke below the range. All right. So again, if I go here, I can see that yes, there is a range. Right. We moved higher, but then we started moving sideways. Now how does this range look on the profile chart? You see it's looking like this. And what is happening, every time we come close to the bottom we get demand, but here it spent a lot of time near the lows, no immediate breakdown. We again try to go higher, but see how bad was this attempt to move higher. If you look at short-term trade facilitation, you can see there was no IB-REX to the upside. If market wants to go higher, it should give you IB-REX. Here there were some range extensions, but the range was very, very narrow, right? And then the range extension was to the downside. And then on this day, we give a clean break. Make sense? So you have to look at higher time frame references. Then I hope you have decided what time frame you are going to trade on. So in my case, it is short swing time frame. So I am now looking at this chart, and I am also trying to find an opportunity to get into a trade. Now this looks like an absorption of demand to me. What it means, we come to the low of the range, and here buyers are not able to push the auction back up. Now if on Monday it starts weak, I might establish a sell position. Makes sense? So this is how I am going to slowly go towards developing a trade idea. This is how I will look at context. Okay, what was the context on higher time frame? It is that you already have a swing low. You already tested it once. Now market, if this swing low was going to be protected, market should have gone higher, but it has not. It has come back to that reference. This is not good. It means buyers are not really as active as they were early on. So we might trade here for a while and then go back up, or we might go down straight away. So that is the higher time frame context. On this 30-minute chart, when I look at it, I see, okay, there is a range, and this looks like an absorption of demand. But now the importance of one lower time frame, or in this case, there are three time frames. One is the discovery time frame, then there is the status quo time frame, and then there is the exhaustion time frame. Now the importance of exhaustion time frame comes in. Okay, so we have a range. The job of the status quo time frame is to maintain this range, so they should come by here and push the auction back up. Job of the discovery time frame is to break this range, so either to the upside or to the downside. All right, but exhaustion time frame, they are just trading shorter term references. So how are they trading? They see market going below previous day's low, they are going to sell all the pullbacks. Okay, so if you see the split view, you see market tries to go back up, it comes to the day's high and yesterday's point of control, selling comes in, pushes the market down. These are shorter term traders, they are selling right at yesterday's high. Okay, now the question is, they are selling right, but what are they doing with their profits? Okay, so some people have sold here, they are booking profits here. Okay, and as the market is going higher, they are selling again. Now if, right, the exhaustion time frame is in control, this will keep happening. Every time market comes to the bottom of the range, these guys will book profits. Every time it goes a little higher, they will sell, and this will create a narrow range. Make sense? Like it has created here a narrow range, and it can continue for a while. Now if in this case the discovery time frame which wants to break this range, all right, they have two options. One, all the demand that is coming in, they absorb that and they sell into that, they overpower the demand and they give a breakdown. Or they have a smarter way of doing this. If they want to overpower the demand, and this is the top of the range and this is the bottom of the range, where are they selling? They are selling at the bottom. But we know smart money wants to do what? Buy low, sell high. Now what they are doing? Selling low. Is it a good idea? No. So they have a better idea. What they will do? They will simply stop selling. As soon as they stop selling, what happens? These shorter time frame traders who are booking profits, their demand will push the market back up, and at some point in time it will break out. But now the smart money is observing the markets. They are observing how far does this rally go. Does it go all the way to the top? Does it stop 50%, halfway? All right, what are the references doing? Say this is that day's high, does it go above that and fail back? Okay, so this immediately tells us that shorter time frame is in control and they're just selling at the highs. Or if it goes back, goes above that sharply and then falls sharply, what it tells us is that this is all shorter time frame, their stop losses were taken out, but there is no interest to the in the markets to the higher side. All right, all this will give us information about what the market is trying to do, and then you can use that information, or the smart money will use that information to establish their trade. So if they see, okay, higher prices are not bringing in new buying, they will start selling, and in that case they will be selling high at this level. Market may come down, consolidate a little and then fall, and this is the consolidation where they will sell. So instead of selling at the lows, they sell a little bit higher. All the weak hands are out. They are not, once their stop loss is hit, they do not have the guts to sell again. So they wait. And then as the market comes back down and it breaks below this reference, this is where they will jump back again as a breakout trade. So what the smart money has done, they have meticulously taken out all the weak hands and used their buying or selling to their advantage. Right, so that is why you have to look at discovery time frame, because they will do such things. Status quo time frame, who will buy at the bottom, sell at the top without any hesitation, and the exhaustion time frame, which can create sideways zones at the extremes on account of regular profit booking. All right, okay, a lot of things, a lot of concepts. All right, so can get a little overwhelming, I understand, but if you focus on the markets this way, you will eventually start getting how to find good trading opportunities. All right, then we go ahead, we have we have to look at confirmation now on this day. All right, uh, I had a example in my mind, I think that is on Nifty. Yes, okay, so let me give you example of confirmation. See, market is going down, you feel the weakness, then market develops an inside day and you see that sellers are exhausted, then we try to go higher. Market develops a higher value area. Now you know that at least on the short term buyers are in control, but the very next day forms an inside day. So what it tells me is that although the value is higher, although the buyer tried to take control, they are now exhausted because they cannot even go above previous day's high. Now, whenever the market gets exhausted, there is a chance that you will get inventory adjustment break. Make sense? So you get an inventory adjustment break, and whenever you are falling because of exhaustion, don't believe in that fall too much because it may not continue. So what happens? Market falls, and I'm talking about this day, August 9th. So let us split that profile. Yes. So why the trade facilitation is so crucial? See what happens. Opens inside previous day's range. So on open, at least you have no confirmation, but immediately goes below the 2-day balance. And that is a good signal. IP range extension and then subsequent range extension also happens. Everything is telling you that markets are likely to go lower. Then what I said, there are two ways you can handle this. Either you have sold the breakdown below B period low, or you wait for a pullback to VWAP. Make sense? So let us now go to the 5-minute chart and I'll show you how it looks there. I think this is the day, yes, August 9th. Okay. So see here. Market opens inside of the previous day's range, goes lower, extends the range below B period low, sharp fall, quick fall happens. And now either you could have sold here or now you are waiting for pullback to VWAP. Now, if you go back and you look at this day's co-trading workshop, I have explicitly stated, many people ask me questions during the trading day, like what to do. And I told them that if VWAP is taken out, get out of your trade. Don't be in short trades. A lot of people had short trades, they got out of their short trades when the market scaled VWAP, and see the follow through. Now, why this is important? Because you need to avoid getting trapped into bad trades. You are not losing money because you're taking you're not booking profits, or uh, you know uh, you are not able to understand the markets. No, you lose money because you get trapped into bad trades. So trading mistakes are what are causing your poor trading results. So when this was happening, the trade facilitation after C period became very, very bad. And when it scaled the VWAP, the rise came into the market, took out this stop losses, took out this stop losses. All right. Now, again, like if you are holding your long trades here, the next day caused a lot of pain for you because it did not continue higher, or you entered late in the day. Why this point was difficult to trade was it was right at the top of the range. All right. So if I draw this range again for you, you can see it was right at the top of the 2-day range. It was right there. So status quo time frame wanted to sell, and they will not look at structure or anything else. They see we are at the top, they will sell. They sold and market went lower. So if you are holding longs, you were punished. And then we continue to move lower. On this day, there are some things, but on this day, we came down. Make sense? So blindly looking at price will cause a lot of trouble. You have to look at trade facilitation. You have to look at important references. You have to look at different time frames and what they do, how they trade in the markets. All right. Okay. So this was a great short-term trading opportunity. You look at this. Even if you sold here, it comes back to that level VWAP, you get out of your trade. So you're prevented from carrying a loss making trade. And as soon as it goes above the VWAP, now you know that this was just inventory adjustment break. It was not going to continue, and the original buying will come back into the markets. And when it closes here, you ask yourself again a question: is it good to continue with this trade despite such a strong move? Where is it closing? Who are likely to come there with their short positions? All right. And will there be an opportunity to buy later? Like if you get out of this trade and again, if it continues, will there be an opportunity? Obviously, there will be an opportunity, because again, market will open. Again, there will be IP range extension. Again, there will be subsequent range extension. Again, there will be pullbacks to VWAP, and all those will give you good trading opportunities. but you have to be patient. You cannot rush into these trades. You have to be patient, give it time, and then you will be able to trade successfully. Make sense? Okay. So VWAP helped us get out of a bad trade and get into a good trade, right? So VSA signals, how they are going to help. Yeah, look at this. This is a great example. I think let me show this example on Bank Nifty. Yes. So we are talking about this August 10 expiry day. See what happens here. I told you that if you are stuck in a sideways range and you have a lot of no demand and no supply signals, it tells you that shorter time frame are in control. Immediately selling this is a bad idea. See what happens here. You're stuck in a range. It tests first and then falls. Tests again and then falls. But when you are testing again, you see lot of actual strong selling signals are there on the chart. In this area it was not there, but here it comes. Then you took a shot, it would have given you nice profits. All right, so you need to understand, when the market is in a consolidation, there will be some sort of testing. All right, and once that testing is not finished, you should not try to get into these positions. Otherwise you will find yourself too early into a position, and then maybe if market decides to do something different, you will be trapped. All right, again you can see this whole area, only no demand, no supply signals. There was a test at the lows, then market went a little higher. Again, I mean, you see a few signals are there, but look at these: no demands and no supplies. This is no supply, no demand, no demand. All right, they are clustered, and that is what resulted in this wild volatility. Maybe some event was there, I'm not really sure, but should have been some event that caused that sharp move. All right, and again, once you get into sideways zone, again you can see these no demands and no supplies clustering, and then you will wait for a test. Right now, here the test was successful and market reversed. Test successful, market reversed. Here the test happened, went back up, never was able to scale the VWAP, so fell back again. So if you want to take intraday trades, these are important points. All right, okay. Now, how would you sell this? That is an important issue. How do you sell this, and how do you buy this? So there is something called as uh, change of color. I just read about this, or I think I watched a video of, it's an intraday trader. So what he talks about is change of color. So here you can see we are continuously going down the red color. As soon as it changes, you buy above the high, you might get a good trade. But you should not always buy when the just color changes. You have to have the context. So here the context was sideways consolidation. This was a test. There was no new supply. As soon as the color changed, you could have taken an intraday trade. This is a very wild volatility. I don't think there was any trade here. But again, you see we are consolidating. Make sense? And some buying comes in here, market goes higher. There was no consistent down move here, but you have 3 bars going up, getting resisted at the VWAP. As soon as the color changes, you can short. Now this, many people, what they try to do is they try to create a system, a very strict set of rules whenever they are talking about intraday trades. Right, so this should not happen, that should happen, and it should look exactly like that. It won't work that way. You need to understand, if you're trading intraday, you're taking short-term trading opportunities, market will give you whipsaws, market will make you take some bad trading decisions, and it will also reward you with some good ones. Right, so you have to be prepared to lose on some of the trades, some money into the markets, because if you're not ready for that, then you won't be able to trade successfully for a long period of time. All right, so you have to be uh, willing to lose some money, but on balance we have to make profits. And for that, the context is very, very crucial, because if you do not focus on context and you end up taking positions just because of the setups, like I told you, the color change, all right, or there is something called as second entry, third entry. So market goes higher, comes back down. This is the first time we have broken a swing low. Don't take that trade. If it does it again, take this trade. It higher chances of working. All right. So, but the question is, all right, the question is, if I just isolate this setup and try to repeat it everywhere, will it work? No. But if the context is correct and the confirmations are there, and the market development is supporting, trade facilitation is happening, and then you go on and apply these principles, you will make profits very, very quickly. All right. So that is the reason why VSA signals also don't work all the time, because you have to have the context. You have to have the support of the higher time frames. You have to look at the exhaustion time frames. Are they creating some issues? Is there a possibility of inventory adjustment? Right. And once you do that, then applying these simple entry and exit techniques will work. All right. Okay. So we talked about the whole process. How many steps are there? 1, 2, 3, 4, 5, 6, 7 steps almost. And I showed you multiple examples of that. So now if you have any questions, I think you can ask in the Q&A window, and I will try to answer those. What references are you using? Is this spot or futures? Let me check the 44 190. Okay, yeah. So 44. This is the region you're talking about. Why I'm using this? Sorry. Right. And in fact, if you look at this whole consolidation, and if you combine these profiles, you will get a composite HVN, and that should be somewhere around 43,800. So not only 44,200, we can even come down to 43,800. That also is possible. Siddesh is saying, what is the best way to find context? Well, I have been trading, for a long time now, and the early part of my trading had no idea about context. I had no idea what context was. It's when I started using market profile is when this context thing surfaced, and then it completely changed my trading. So I would advise you to look at this daily chart with volume profile and market profile chart to understand context on higher time frame, like long swing time frame and short swing time frame, and then you can develop a trading method to trade intraday or short swing, whatever suits your trading style better. So market profile is the foremost thing. That market profile is all about context, nothing else, right? There are no signals and there are nothing there on the market profile chart apart from context. And obviously volume profiles on higher time frame chart will also be better. Yogesh is saying very advanced concept, need details, detailed study, very well explained. Thank you. Yogesh, yeah, the first time you come across such a concept, it becomes a little overwhelming. I can understand. I'll tell you my story, because when I first came across market profile, in those days I was like jumping from one tool to another like a monkey. But then what happened, I came across market profile, and I gave up on market profile. I said, okay, this is not for me. I'm not going to use it. I completely gave up on it, only to realize its importance the second time. All right. And it's a funny story that many people know me for market profile, but I came across volume spread analysis much before that. Like long back, way before that, I came across volume spread analysis. I gave up on that tool also. Now what I've realized is that as your maturity as a trader increases, all right, as you improve your overall understanding of the market, then you will be able to make sense of some of the tools. Okay, so if you come to market profile, first time round, nothing is going to make sense and it becomes very, very difficult to understand. That is the reason why, Bill TPO and me, we are working a lot in this field of educating traders. All right, so the courses are very, very helpful. The YouTube channel has a bunch of videos about market profile. But yeah, once you get the hang of it, then I don't think you will need any other tool to trade. Absolutely nothing else. Okay, Prasanjit is saying in Bank Nifty yesterday, LNM periods break poor low. This is a stop hunt, right? Can we predict the stop hunt? No, you cannot predict anything in the markets. And always remember, in market profile, the L period and M period, these are not reliable. All right. And I'll give you a fantastic example of this. Go to Nifty and look at the August 9 close. See, now that I tell you it was near this high and this maybe this HVN and all this. Once I put it in context, you may be able to understand why this was bad. But if you're just looking at price, okay, see, I'll try to show you this way. Okay, now you tell me, when you look at this market, tried to go down and now it's going up and closing here. Don't you think that the market is extremely strong? But this is what? This is LNM period. They have no confirmation. The confirmation comes the next day. And how did the confirmation come to us? In the form of a lower open. Now, when you look at this open or this initial activity, do you think that the strength is still there? No. The VWAP tried to hold the markets. There was some RBI event and then market broke down. Make sense? So that is the reason why L and M period are not reliable letters or time periods to make assessment about markets. But yes, if the market goes higher, right, then it will confirm that yes, there was some stop and below this low or these clustered lows A, D, and H. Okay, but not while we are in LNM period. It cannot be confirmed there. Shekhar says, thank you. You're welcome. Siddesh says, can you throw some insights on inventory adjustments? Yes, absolutely. I think this Nifty example we discussed was inventory adjustment. See, usually what happens is, like in this case, you can see markets are stuck in a range. Every time you go to the top or go to the bottom, we are seeing some profit booking. And in this case, let's say the market eventually wants to go higher, they will first go lower, take out the stop losses, throw these weak buyers out of their positions, even encourage them to short and then reverse, right? Unfortunately, we did not get the continuation we required, but this kind of activity happens all the time. Okay, so it is to take out shorter time frame traders. Okay, sometimes they get like the market got stuck in this range. Why? Every time it came to the top, selling came in. Every time it came to the bottom, buying came in. Now higher time frames, they cannot make money in the range of this 150 points. They want, let's say, 500-point move. How will they do that? They will do that by taking the stop losses out. And the stop loss hunting is nothing but inventory adjustment. All right, so again, the sellers got exhausted. All right, shorter time frame sellers were kind of trying to uh, take trades in this zone, and that is why as soon as we went above VWAP, the market went higher, because everyone who shorted here and had not covered their position, they started feeling the loss and the market blasted to the upside. Satish is saying, Dean, in Nifty daily chart, previous month there is a low usage area. Now we are trying to complete low usage area. Next market, decide where to go. Your thoughts on this? Okay, this is regarding Nifty daily chart. Yes. So in Nifty, what we saw, this is the month of July, is that first we consolidated here, then we break out and we consolidated at a higher level, and that gave rise to two distinct distributions with low usage area in between. This whole area where there is no yellow lines, this is the volume profile, so very little volume traded here. And what we are doing here, exactly filling this area. And once this area is filled, now this whole profile is complete, and yes, we can fall. And I think I just showed examples of this to my uh, members, all right, co-trading workshop members. uh, there is another fantastic tool that Build TP offers, and that is Build Dynamic Profile. All right. So let's say I start here. Okay, start here, and I start moving to the right, and this is what I get now. Okay. Now compare this profile where there is a big low usage area in between to this full profile which has even this trading included. Now there is very little low usage area. Can you see? Compare this big hole to this. So now in fact, if we immediately start falling also, that is allowed, because most of the areas have been given enough opportunity to facilitate trade, to make sure that yes, buyers sellers get fair opportunity to express themselves. Now that they have all the opportunity and they may have completed it, it can again go higher, spend some time and fall. That is a possibility. But yes, if it decides to fall, it is allowed, and it can come and test this lower distribution, right? So this Build Dynamic Profile is again an invaluable tool. I use it all the time. I hope Satish, you got your answer. Giri is saying, sir, where order flow comes into picture in this context? Well, order flow comes into picture if you are like scalping, all right? I have kind of, reduced my use of order flow chart, but it can be used to get confirmation. But most of the times I feel that when I look at an order flow chart, I believe that it is suitable for very, very, shorter time frame trading. So I don't say refer to the order flow chart much, but sometimes I especially when there are freak highs and freak lows, or when there is a very rapid move, I will come here and I'll check, whether there is an imbalance. You can use this chart and see there is such big imbalance here, right? Again, an imbalance here, and market revisits that imbalance, supply comes in again. So, but again, this is a very short term, kind of trading. So see here again, there is strong imbalance here. Market goes and tests the top of that imbalance, supply comes in, and we fall sharply. So now don't convert this into setups, all right? I don't like to continuously look at order flow chart, because I'll tell you the reason. The top down approach that we talked about, and the time frame that I'm trading from, short swing time frame. Once I start on the daily chart, I come to the profile chart, and by the time at the VSA chart, my trade idea is fixed, my trade execution is finalized, everything is finalized, so I don't have to move further. All right. So many times it has happened that I don't even look at VSA chart, just on the market profile chart my decisions are made and I take the trade. But yes, if you want to trade intraday, then this 3-minute VSA chart is extremely essential. Then you can use this 3-minute order flow chart to confirm where you are getting those clusters, where there is a potential stop hunt and all those kinds of things. All right. So in that way, order flow can be invaluable. So this is saying, Dean, in Bank Nifty yesterday was looking like absorption of demand, and if Monday we get a good trend down day, bearish credit spread is good, and adjustment level is RBI event day and before day composite HN. Yes, absolutely right. If you get continuation to the downside on Monday, I think that will give you much lower prices, and the adjustment levels that you're talking about are correct. And the adjustment level that Satish is referring to is in regards to the credit spread option strategy that I suggest you should use, or I personally use. So it's a whole strategy, and if things go wrong, how to manage that and how to make adjustments, everything is covered. So that is the study that he is referring to, and Satish has been interacting with me for a long time. So uh, maybe someone new here may not have that reference. Shekhar is saying, sir, please explain inventory adjustment in layman's language if possible. Well, uh, well, see, I'll tell you, the whole issue of trading is a language issue. All right. um, Now that you have used the word layman language, that's why I'm saying this. uh, when I explain the inventory adjustment, it is a little bit difficult for you to understand because you do not have all the tools to understand it, right? So like there is head and shoulders, all right. uh, Everyone knows this pattern. We have been looking at this for a long time. We have that language understood. So immediately I can explain this very simply. But explaining inventory adjustment is not that easy unless you understand a lot of other market profile concept. It is not difficult to understand, but that you do not have the full language, it will become difficult to make sense of what I'm saying, right? But again, let me check. If I have any good examples. Sometimes when you really want, an example, you just simply cannot find it. All right. Okay. This looks like an inventory adjustment. I'll explain here. All right. Okay. So what inventory adjustment means is that very simply, uh, if there is a down move, all right. Uh, so people are selling. Okay. Smart money wants to sell. Now, eventually, smart money wants to reach here. That is their eventual target. But as soon as we come to this level, what happens is a lot of traders who are trading from short term, they will start buying here. Okay. So market, every time it comes here, it goes back up. Every time it comes here, it goes back up. But there is a strong trend. So every time it goes up, again, selling comes in. But every time it comes here, buying comes in. So that will create a narrow range. All right. Now, if the smart money wants to go lower, again, as I said, either they have to absorb this buying, or whoever is selling here and buying again here, they have to take them out of the equations. How do they do that? They also are selling, right? They are selling, the market is going down, they want to take it further down. So instead of selling here, they stop selling. And as soon as the smarter money stops selling or higher time frame stops selling, there is a quick reaction. Okay. Now what has happened? Market has gone higher. These guys who were selling, their stop losses are hit. Market is going up, and these guys are now thinking about reversing their position and taking a long trade. As soon as they start to buy or their stop losses are getting hit, smart money will come in from the other side and they will take the other side of their position. And as soon as this initial hunting is over, or small buying that comes in, that is taken care of, market will start going down, and this time the smart money will sell. Why? Because the retail traders, their stop loss of short is hit. Now every time the market goes down, they are looking at buying a pullback, so they will buy and these guys will sell. So smart money will sell, retail will buy, and the market will just go down, and this time there will be no resistance here, because now this is the low below which the retail traders stop losses are there. So this rally was the inventory adjustment. Inventory means who is holding longs and shorts, right? Now here you can see, when the market wants to go lower, the smart money wants to hold the long and retail should be holding, the smart money wants to hold the shorts and retail should be holding the longs. But here it was different. Retails were getting excessively short. Every time they got an opportunity, they got short. All right. And if the retails are holding the shorts, as soon as they get previous supports, they will buy, and that will create a sideways zone, and that will not create a trend. So now what happens? They create this rally, stop losses are hit. As soon as stop losses are hit, retails are thrown out of shorts. Now they have no position, and their shorts, who is taking the other side? They are thrown out of their shorts, and if they are getting out of their shorts, they are buying. All right, let me write buy here. So who's taking the other side of their buy trades? Who's selling? It is the smart money. They have limit orders here. So as soon as their stop losses are getting hit and they are buying, smart money is selling. So now smart money holds the shorts and retail have no position. As the market goes lower, they will buy. So they will hold the longs, and the smart money is now happy because as soon as this important reference is broken, these longs will throw in their trades, their stop losses will hit, and that will accelerate the down move. Smart money will get good profits. I hope this answers. But again, as I said, it takes some time to get all the concepts of market profile. But once you understand those concepts, I am telling you, you will never go back to a price action chart or candlestick chart. All right. Girik is saying thank you. Rajesh is saying, Dean, for intraday to watch for reference VWAP, do I need to watch daily VWAP for 30 minutes? No, no, no. VWAP should be plotted on intraday chart. So 3 or 5 minute chart is enough. Even 30-minute chart, the values will be a little different because the way it is calculated, but any intraday chart is enough. Don't go for higher time frame charts. Satish saying on August 9 and 10, I was a bit convinced with sellers just waiting for confirmation on August 9 and 10th. We move value downside. Is this better thought process to think on these lines? What index are you talking about? Well, see, when you get these kinds of spikes and they are rejected, then these are actually really good places to get short. Okay. So because the value is here, we have moved away from the value and instead of continuation, we are rejecting it. So there is a very good chance that it will come back to this value. So selling at these higher levels is very, very advantageous. So but these are context based trades, so not that easy to pick and execute. But if you can do that, then that is actually advisable. Satish is saying thank you for the session. Good brush on the basics. Happy to be here. Yeah, same here. Anway is saying thanks, Dean. Good session. Thank you. All right, guys. I'll take one more question and then I will stop. So maybe one or two question max, and then we will call it a day. All right. Shekhar is saying thank you so much, sir. Now I understood since 1.5 months I have stopped looking at the charts conventionally. Now I don't use conventional indicator. I am already your student. I have not watched the full videos yet. Thank you so much. Yes, yes, I am very happy to have you, and I hope that the content will help you. All right, guys. Yes, thank you, guys. Thanks a lot.